Reminder, my name is Charlie Banks. I'm the co-founder and managing director of Venture South.
I'm Dawson. I help manage our due diligence and deal flow, so meeting with a lot of the companies before they make it into our pipeline and then kind of bring them through to meet with our investors and then moving into our investment stage.
Very good. Well, I won't kind of rehash our data points. Yes, this is a little bit of a outdated slide, but the takeaway is we've done this a lot, a whole lot. So we're approaching, I guess, a little over $80 million total deployed, and 115 companies. So again, it's a little outdated, but needless to say, we've done this a lot, and we've got a unique perspective on the asset class. So angel investors. Does anybody really know what that means, or where the term came from? I guess by now you see on the slide that gives it away, but the term angel investors was coined during the Depression. These were the folks individuals who brought their own money to the table to get our economy out of the Depression. They were called angels. So that term stuck. So angel investors is now what we know them today. So just to kind of set the stage a little bit before you guys, so when we talk about angel investing, that we're talking about kind of where we invest, on the development cycle of a company. So here's a quick graphic on the stage and capital needs. That seed stage is when a company's raising $1,000 to $100,000, and typically that's from bootstrapping, grants, friends, family, and fools. There you go. Friends, family, and fools are where a lot of the money comes at the seed stage. Kind of on down the line, you've got where venture capitalists lie. You've got banks, private equity, public markets. That's on down the development cycle of a company. But we fall right here. So typically these companies are raising a couple $100,000 up to a few $1 million. There's that startup phase. So angel investors are individuals who are accredited. Accredited is a definition that it's a little silly, but the government decided years ago that they would like to determine who can and can't invest in early stage companies. So they came up with a term called accreditation. So you must be an accredited investor to be an angel investor. And what that means is that you've got $1 million in investable assets minus the value of your personal residence, or you make $200,000 a year individually, or $300,000 combined with who you file your tax returns with. So that is just a definition of accredited investor is that, and those are the folks that typically are making these types of investments, and they're investing their own capital and their own expertise in early stage ventures. So what are angel investors not? These are not angel investors, right? However, Shark Tank has been a double-edged sword for us since they started. The good news is that it has brought to the forefront the idea of investing in early stage companies. It's fun, it's sexy, it's cool. So that's been a good thing. That anybody with money says, man, I want to do that. I want to go do that. So how do I do that? The other end of that is the investors saying, I don't have, $1 million laying around to put to work. So I can never do this. So that's the bad news in terms of investors. Entrepreneurs, the good news is that everybody wants to be on Shark Tank. Now everybody with any good or really bad idea thinks they should be on Shark Tank, which it brings us a lot of pipeline, and that's a good thing. It gives us opportunities to invest. But the bad news is that everybody thinks they could be an entrepreneur. Everybody with a good idea or a bad idea thinks they can do this. That's kind of the double-edged sword of Shark Tank. Dawson, what's the difference between angels and venture capitalists?
Yeah, so although they invest in the same asset class in early stage companies, they're pretty different in how they operate. Angel investors, they're making their own decisions. They're actually very hands-on with the companies they work with. Like we talked about yesterday, usually angel investors take an early board seat where they're able to help the founder out. They're able to make connections. They're able to, if they have expertise in supply chain or HR, whatever it may be, they're able to actually get their hands dirty and help the startup. Venture capitalists can do that and have the bandwidth to do that, but typically they're managing other people's money. So they will raise a pool of funds where they will invest based on a certain thesis, as the angels have their own thesis. They get to make up their own ways that they want to invest their money and who they want to invest it on. While the venture capitalists, you're trusting your money into someone who's going to manage a fund that will invest in 20 to 30 companies over the life cycle of the fund and then provide you with a return, whereas you don't have as much hands-on as an angel.
Yeah, a quick plug is just remember, at Venture South, we're both. So we have an angel investor network that individuals make their own decisions, and then we have more traditional funds that will make us venture capitalists as well. All right, Dawson, what do angels invest in?
So typically angels will invest in a few different areas. When we look at geography, Venture South invests in the Southeast. Now, if you're living in San Francisco, if you're living in Atlanta, if you're living in Boston, you may want to invest in your city specifically. Jacksonville here, you may want to invest specifically in startups in Jacksonville. So typically, angels will invest in startups that are close to range so they, one, can go to their office and help them out, make meaningful connections where the startup is and the founder is, and kind of be a hometown player and really help out their city. So that's what typical angels will want to invest in is kind of in that 2 to 3 hour radius where they can, or somewhere they travel a lot. The stage, like we talked about, we want to see a short-term path, right? We want to see them at least have initial traction to say, someone's going to pay $1 for my product. We're going to get that first dollar of revenue. So they might be on the cusp of getting revenue, or they might have gotten a few pilot customers that aren't paying yet but are going to pay in the future. So that's kind of the stage that angel investors will play in. The team, a good team, right? A founder, it's crucial for the growth of a startup to have a good team and a founder that's surrounded by strategic advisors, early stage angels that are able to help them grow, whether they're based in the industry, and teams that are complementary to the founder himself.
Yeah, so you may have heard the term, we're betting on the jockey, not the horse. And that's very, very true at early stage investing. That you have to have a good gut feel on whether or not this team is the right team that's going to execute on the plan that they've sold you on.
Or whether to pivot as well. Markets, usually angels will invest in anything, but specific to you, when you look at your expertise and your past experience of where you work, where you lie, whether you're in the medical field, whether you're in the fintech field, you know that field really well. So you're going to want to invest in that field because you know that market, you know those customers the most. So typically, angels will be agnostic with any sort of industry, but we see a lot of our angels investors invest in what they know, and we want them to because your expertise is very valuable. And the structure of our deals, typically, you want to, there's 3 structures we could get into the weeds on, but you want to get equity, right? You want to have equity in the company so you have rights, you have information rights, you have actual skin in the game. You're able to actually help the founder and be involved with the founder. And you want to target a return of 50% plus because you're taking on a huge risk in this asset class. And your IRR has to be 50%, which beats the market well above your average of 8% to compensate for the risk you're taking.
Yeah, so the good takeaway there is that we're not lenders, right? We're not loaning money to the company. We are investing money into the company for a stake in the company, an ownership stake in the company. Usually it's a minority ownership stake, but it is an ownership stake in the company. All right. Dawson, talk about the different ways to do it.
So I kind of talked a little bit about this previously. On the left, we have angel groups, and that's more of an active investor. You're actively meeting with founders. You're actively working with the founder and understanding the product. You're doing diligence. You're meeting with the team that's doing diligence. You're actively investing in the companies, and you're pretty well engaged with the founder that you're investing in. So that's more of the active model. And it's like you're picking your own stock, right? And you're doing your diligence on the stock or on the founder, right? The passive way, like we talked about, is investing in a fund. So if you don't have the time to do that and you don't want to do that, or maybe you feel like you're not equipped to do that yet, so you need some education and you want to still get in the asset class, you can diversify and put specifically in a fund. So there's, a few funds right there where, there's, like I said, it's a pool of capital where you put your money in and you're diversified, which is a great strategy to diversify into multiple startups instead of trying to pick the winners yourself. Both have pros and cons to them.
Yeah, and a lot of folks do both. A lot of folks do both. All right, so we've got about 10 minutes left, so we're gonna fly through these. So these are the top 10 myths associated with angel investing. This is part of a much longer course that we do, and as a member of or an investor in Venture South, we do a monthly education workshop. So this is kind of one of those, and it's everything from cap tables, term sheets, valuations, due diligence, board governance, exit strategies, Angel 101. So it really is a treasure trove of information and education that's really, it really equips folks to be active in the asset class. We tell folks often is that you shouldn't be making investments in early stage companies until you understand what cap tables, term sheets, valuations, board governance, all of those things. And so we do a lot of education. All right, so myth number one, capital is scarce. Capital is not scarce, y'all. The best companies, the good companies, they always get funded. They always get funded, all right? So capital is not scarce. Historically, though, in the Southeast, one could argue that the capital is not as abundant as you would get in Silicon Valley, Austin, Boston, New York. Over the last decade, that has shifted dramatically. So capital is not scarce. Number two, you need to write big checks. Our minimum investment in any given deal is only $5,000. So back to the Shark Tank reference, where those guys are investing lots and lots and lots of money. We're only, our minimum is only $5,000. Now the average is about $10,000 to $12,000 in any given deal, but that number is skewed heavily because we've got a whole lot of folks that invest $5,000, $7,000, $10,000 in every deal. We've got a subset that invest, $25,000, $50,000, and then we've got a subset that invests $250,000+ in deals. But the beauty of the model is that it's the same. The model and the path to do this is the same for the $5,000 investor as it is for the $250,000 investor. Number three, you can pick a winner. I promise you can't pick a winner. I have looked at literally tens of thousands of companies over the last 12 years or so, and I can tell you that you can't pick a winner. You cannot do it. You just have to be in the game, right? You got to understand that portfolio math. And I talked about that a little bit yesterday. Good rule of thumb is half the deals you invest in are going to return to zero. 25% of the deals you invest in will likely get your money back, and that top quartile is where you get your outside, your gain. So diversification is the only way to do this. One-off deals don't work. I had a great conversation with a guy yesterday who previously had set up a family office to do angel investing. That was part of their strategy, and they got real excited about two deals. Both of them went to zero, and he said, "Man, we'll never do this again." And we hear that all the time. Number four, diversification takes too long. We have plenty of opportunities. I think we have 21 open rounds right now. And if you go back to what I just said about diversification, that is the key. This is an outdated one. We have 21 open rounds. Go ahead, Dawson.
Yeah, so the fifth one is that it's only for experts. Like we said, it can be for anybody. We have a lot of people that are learning. The education piece is huge. Education is everything for us, from learning all those things that Charlie just talked about. We have tons of workshops. There's tons of books. I like Jason Calacanis' Angel book. Granted, he did pick a winner. He picked Uber, but he had diversified into a ton, and his syndication list is hundreds of investments.
Yeah, there's one book that's not up there. It's called Get In, Get Out. It's written by a Southeast. He's actually a Venture South member. He's based in Greenville now. But the way this book is written is really cool. So if you open up the left-hand side of the page is, pick a topic. Let's say market size. The left-hand side of the page is what an entrepreneur thinks of market size. The right-hand side of the page is what an investor thinks of the same topic. So it's a really cool, unique book. So write that out. Get in, get out. So obviously, it's better when done with others. Diverse backgrounds are critical. I was speaking to a guy this morning about kind of what that means to us. And the collective expertise factor for Venture South is huge. And that's really important, whether you join Venture South or any of the other groups, networks, funds, firms, et cetera. Do it with others, right? Do it with others is really important because, having different point of view into the same deal, different opinions, is a really good way to mitigate your risk. Myth number 6, you can't make any money. So if you look at the national benchmarks from the ACA, the Angel Capital Association, if you're involved in a professionally curated platform or process, that's the IRR, it's pretty healthy. It's pretty healthy. But it's risky. It's super risky. So you got to be patient and you got to diversify. Go ahead, Dawson. I'll just take this one.
Yeah, like we talked about, it's too expensive. Typically, you see a Shark Tank angel investor, Mark Cuban invests $500K. That we wanted to do it and keep it democratized to where it's $5,000. It can be expensive to do it alone. It can be really expensive with your legal fees, with all of your due diligence, with monitoring it, with the accountants. Having the platform is really helpful, but doing it alone can be pretty hard unless you've got a full tax team, a full accounting team for your personal. It can be pretty expensive that way.
Yeah, raise your hand if you like K1s. I see no hands in the air. Yeah. We deal with literally thousands upon thousands of K1s every year. And imagine what it would take to do that just to manage your own portfolio of dozens. Because you remember, portfolio math, you need to be in a lot of companies. Good rule of thumb is that you need to be in at least 8, 10, or 12 deals to make sure that the math is in your favor. So that's a whole lot of K1s. And no matter how many investments you make in any given year with Venture South, you get one K1. Returns take too long. Myth number 8. So we've exited 18 companies, and the average hold time of those companies it's about 2.5 years. Getting in and getting out is a big part of this. If you ask every entrepreneur that has ever pitched, you would say, when are you going to exit? They would say, we're looking to exit in 3 to 5 years, probably because they read the books, and that's what investors want to hear. But the reality is that's the goal. That's the benchmark, is can we get in and get out in 3 to 5 years? We want them to fail fast, and we want them to succeed fast as well. So again, it's that the myth is that returns take too long, and that's not the case. Now, we do have some in the portfolio that have been around for 10 plus years. They're zombies at this point. They're still there. They're making money. They just haven't exited yet. Myth number 9 is time consuming. Yeah, it is. It's time consuming, right? It is. However, if you do it in a professionally curated manner, it's not. You can get as involved or as passive as you want. When I say that, what that means is, as a member, you can sit in the screening meetings. You can sit in due diligence teams. You can take part in our monthly meetings. You can get as involved as you'd ever imagine. We have something to do almost 3 days a week, probably for investors now, whether it's education, diligence, et cetera. You can really get involved. On the other end of the spectrum is that you can be entirely passive and not do this. So those are kind of the spectrum as it relates to the asset class. You're not buying yourself a job. That's really important. We see a lot of investors that have done this, but they put money into a company, and then they ask the company to hire them for a myriad of different ways. That's not a really good way to do that. Now, obviously, there's times when that would make sense, but the key takeaway here is you're not buying yourself a job. You're building a portfolio of these companies to make money. Unicorns. Myth number 10, the last myth, is that there aren't any local unicorns. Huge myth. Unicorn, by the way, is $1 billion value. A company's valued at $1 billion. That is a myth. There are a bunch, and that list is ever growing. So when we talk about unicorns, we don't really need unicorns to make money with in the asset class. What you need is, I'll show you a picture of what you need in a minute, but a Southeastern angel investment strategy is this. You invest in a company at a $2 million valuation. Company does well, it scales, it grows, things are going well, the company is going to be successful. A strategic buyer comes in, buys that company for $20 million, very under the radar. You get a 10x return, right? So that's kind of the way we think about it. We don't need these massive Uber-like, I guess that's a pun these days. We don't need Uber-like returns to make money in this. I tell folks often is that we would rather have a 3x return in 3 years versus a 5x return in 10 years. So we are IRR, internal rate of return investors, and then rinse and repeat. So when I think of a Southeast unicorn, this is what I think about. A golden retriever, good family dog, good family company. This is what I think about when I think of a Southeast unicorn. So I'm going to sum it up real quick for you guys. I'm not going to go through it, but I'll leave this up for a second as we talk. Just remember, everybody can do this. If you're accredited, and your money is being managed by a private money manager, whether it be Merrill Lynch, fill in the blank, they're putting you in a 5% alternative asset class. They're already doing that. That's where we play. So this is an opportunity for you to do that on your own, have a heck of a lot of fun, sit on boards, sit on due diligence teams, kind of scratch your intellectual itch. We've had members tell us that Venture South is their intellectual country club, and I've always thought that was a good way to do that. Finally, what I want to kind of wrap it up with is kind of alignment. So these are the keys to success. You've got your core, and you've got your secondary. Honesty, patience, due diligence, and objective alignment, in my opinion, are the top 4 ways to be successful in this, and then there's some secondary. Last slide on this is that a little bit deeper dive, objective alignment. So for the entrepreneurs in the room, I want them to take away this, as well as the investors. In my opinion, the most important thing in doing this is to make sure that you as the investor and the entrepreneur are on the same page. You've got to have that objective alignment. If you're building this company to pass down to your kids, for example, but your money is trying to exit in a couple years, the alignment is just not there, right? So that's just one example of a way that the objectives, if the objectives are aligned, it could be problematic. So that's just kind of my final takeaway. Dawson, anything you want to sum up with?
That's great. If you're not aligned, there's friction. And then it's not as fun as angel investing is, because there's friction, and you want it to be fun. You want to be involved. It's like you're joining their team. Like you said, you can be as involved as you want to be, or you don't have to be. But if you're involved, you really can have a lot of fun doing this. All right.
Well, guys, thank you so much. Again, this is kind of part of a much larger course. If this is something you're interested in, let us know.
Thank you.